Welcome to the Explainer. So, are you ready to discover a trading method that actually bridges the gap between the chaotic, frantic pace of day trading and the super slow crawl of long-term investing? Well, today we're exploring the 4-hour swing trading strategy. In this specific approach, every single candlestick on your chart represents exactly 4 hours of time. It is an absolutely brilliant way to cut straight through all that market noise and build a clear, confident roadmap for your market analysis, especially if you're a beginner.
But first, I gotta ask, are you just way too busy to stare at charts all day long? You know, studies actually show a massive percentage of day traders completely burn out within their very first year, simply from screen fatigue. You might be feeling totally overwhelmed by that erratic, minute-by-minute noise. But then again, maybe you also lack the patience to wait around for months on end just to find a single setup in weekly investing.
When you look at the extremes of trading, it can honestly feel like a lose-lose situation. On one hand, you've got those 15-minute charts. They're just filled with anxiety-inducing noise, making you nervously check your phone while you're at work. On the other hand, daily charts can feel painfully sluggish, leaving you bored and waiting weeks to actually execute a trade. What we desperately need is to find the Goldilocks zone of trading, a time frame that is, well, just right.
Okay, let's dive into this. Here is our roadmap for the Explainer. First, the 4-hour sweet spot. Then, Step 1, identify the trend. Next, Step 2, the pullback zone. After that, Step 3, candlestick triggers. And finally, Step 4, managing your risk.
Let's kick things off with our first point, the 4-hour sweet spot. So why exactly 4 hours? Well, the 4-hour chart is quite literally the sweet spot because it neatly wraps up the major institutional session blocks, we're talking New York, Asia, and Europe, in real time. This is absolutely crucial to understand because major banks and institutions are the ones actually moving the market with their massive volume. Since a single 4-hour candle captures their entire workday, it gives you this incredible structural reliability, but you still get the precise entry timing you need to actually succeed.
All right, moving right along to the playbook itself. Step 1, identify the trend.
Listen, trading is all about objective math. It is not about guessing. We need a definitive, hard and fast rule to tell us which way the market is moving, and we do this using a 200 exponential moving average, or EMA. Think of the 200 EMA simply as a line calculating the average price over the last 200 candles. It acts just like a powerful river's current, and you never, ever want to swim against it. If the price is positioned above the 200 EMA, our trend bias is officially bullish, and we're only looking for buy setups. If it's below, the bias is bearish, and we are exclusively looking for sells.
Which brings us to Step 2, the pullback zone. Once we actually know the direction of that river's current, we never chase the price when it's running away from us. Instead, we basically set a trap. We wait patiently for the price to pull back to us, and we do this using confluence zones. We want the price to retrace into key moving average levels, specifically looking at the 50-period EMA or the zone between the 23 and 38-period EMAs. We also love it when these line up with previous support or resistance plus Fibonacci levels. Those are basically hidden math-based levels, specifically the 38.2 to 61.8% zone, where price naturally likes to take a breather. When the price dips into these dynamic zones, it primes a super powerful bounce back in the direction of our main trend.
Now we're getting to the fun part. Step 3, candlestick triggers.
Okay, so we don't just blindly jump in the second the price hits our zone, right? We need a signal, that spark that lights the fire. Our first major trigger is the pin bar. This is a single candlestick with a small body and a long tail, or wick, indicating a really sharp rejection of a level. I want you to look at that long wick as the visual scar of a battle. It physically shows you where one side aggressively pushed the price into our zone, and the other side violently slapped it right back out.
And our second trigger is the engulfing pattern. This is a 2-candle formation, where the second candle's real body completely covers, or engulfs, the previous candle's body, which brilliantly illustrates a massive shift in momentum. Now keep in mind, an engulfing candle is totally useless if it's just floating out in empty space. Its predictive power comes only when buyers or sellers completely overwhelm the opposing side right inside those specific EMA confluence zones we just talked about.
So, let's put this all together. If we're cruising comfortably above that 200 EMA river, we want a bullish trigger. We're on the lookout for a pin bar or an engulfing candle bouncing up off our support zone. Conversely, if we are drowning down below the 200 EMA, we want a bearish trigger, rejecting resistance and moving down. It's a completely symmetrical playbook. The direction just depends entirely on what that larger trend is doing.
And finally, this safety net.
Step 4. Managing your risk.
Look, even the absolute best, most pristine candlestick setups require a strict safety net because, frankly, no strategy on earth wins all the time. That brings us to a crucial rule: 2%. That is the absolute maximum amount of your account capital you should ever risk on a single trade, period. Even professional traders go through streaks of 4 or 5 losses in a row. At 2% risk, you barely even feel it, and you survive to trade another day. But if you risk 10% per trade, half your account is instantly wiped out after a bad week.
To protect your hard-earned capital, you absolutely must follow these exact steps. First up, place your stop loss just beyond the recent swing high or low, which is simply the most recent obvious peak or valley you see on the chart. Second, set your take profit 1 or TP1 at the previous high or low target. Third, the second the TP1 target gets hit, you immediately move your stop loss up to your entry price. This brings you to break even, which completely removes the risk from the rest of the trade. Free ride from there.
But here is the real secret sauce of this whole strategy: maintaining a risk versus reward target of 1 to 3. This means you're risking 1 part to potentially make a reward of 3 parts. Think about the math on that for a second. Targeting a 1 to 3 ratio means you could literally lose 60% of your trades, yes, more than half, and still come out highly profitable over the long run. Knowing your winning trades are 3 times larger than your losers is an incredibly comforting fact for anyone just starting out.
Ultimately, the core philosophy we've explored in today's explainer is that consistency, patience, and actually learning market behavior are the true keys to long-term trading success. Crushing it with this 4-hour approach doesn't come from having some magical crystal ball to predict the future. It comes from removing the raw emotion and the stress from your day. You just patiently wait for the price to hit your defined zones, and you ruthlessly follow your rules when the triggers finally show up. So now that you've got the complete structure for the 4-hour swing trading playbook, what's your next move? Are you going to let the frantic noise of the 15-minute chart keep burning you out? Or are you going to step back, find that 4-hour sweet spot, and let the market finally come to you? Go ahead, pull up a chart right now, drop the 200 EMA on it, and see the matrix for yourself. Thanks for joining me.